Hi guys, welcome to another video from Little Too Simple. In 2008, Warren Buffett issued a challenge to the hedge fund industry. He said that after including fees, costs, and expenses, an S&P 500 index fund would outperform a hand-picked portfolio of hedge funds over 10 years. A hedge fund, Protégé Partners LLC, accepted the challenge and the two parties placed a $1 million bet. The contest was scheduled to end on 31st of December 2017, but Protégé Partners conceded defeat as early as 2015. This raises a fundamental question. Why do the super rich keep investing their money in hedge funds despite them not being able to beat the broader markets in terms of net returns? And more importantly, why do they continue despite these funds being disliked by most retail investors? A sentiment that became evident during the GameStop saga in 2021. Well, we will answer these exact questions in this video. If you find these kinds of videos interesting, please explore our channel for many more on personal finance, financial success stories, and business case studies. Now, let's roll. Despite how it might look on the surface, one needs to understand that super rich people are some of the smartest individuals in the world. They didn't become super rich by blindly investing their money anywhere. There are multiple reasons why the super rich invest their money in hedge funds instead of simply investing it in the S&P 500 index fund. It's true that index funds often offer better returns than a lot of hedge funds. But hedge funds, despite their high fees, costs, and expenses, provide a few unique advantages to the super rich. Super rich people generally invest huge sums of money, sometimes even billions of dollars in one go. Often, it is almost impossible to invest that kind of money into instruments such as the S&P 500 or other index funds without actually moving the markets. And as some of you might know, moving the markets can lead to troubles and unnecessary regulatory scrutiny, even if it was unintentional. This is the same reason Bill Gates sold his Microsoft stock over a span of more than 20 years instead of dumping it all at once. Hedge funds are structured to avoid this problem altogether, allowing the super rich to invest any amount of money without worrying about legal, regulatory, or market-related trouble. In plain English, the term hedge means a way of protecting oneself against financial loss or adverse circumstances. That's precisely what hedge funds do, hence the name. In most cases, hedge fund returns are not correlated to stock markets. They often provide positive returns even during periods of bad economic and market conditions. Hedge funds achieve this by diversifying their portfolios, investing in many different financial instruments and alternative asset classes that are not directly tied to stock markets. If there's one thing the super rich hate, it's instability and volatility. They prefer hedge funds because these are less volatile than stock markets and more often than not, provide stable returns. Of course, hedge funds are not completely risk-free. As seen in 2008, some had excessive exposure to a single asset class such as real estate and went down with it. But a lot has changed since then. Today, most hedge funds have highly diversified portfolios, which mitigates risks even if a certain asset class underperforms. Thus, the super rich invest in hedge funds primarily to hedge against bad economic conditions and ensure their investments stay in the green at all times. Many of you might have heard this caution about index funds. Invest only if you can stay invested for the long term. There's a good reason for that. Since stock markets can be volatile in the short term, investing for the short term in index funds can actually result in losses. This is why Warren Buffett's challenge to hedge funds was over a 10-year horizon. But here's the thing, the super rich love having access to their money whenever they see an opportunity to invest in the next Tesla or Facebook. Since hedge funds usually offer stable returns, they give the super rich the flexibility to access their money without worrying about short-term market conditions. The same cannot be said about index funds. If someone withdraws from an index fund during a bad market phase, they might have no choice but to withdraw at a loss. And the super rich hate losses. Hence, they prefer hedge funds, which keep them in the green more consistently, independent of broader market conditions. We hope we've explained why the super rich invest in hedge funds instead of index funds, despite the high fees charged by hedge funds. It also shows how smart these individuals are, and why they became super rich in the first place. The purpose of this video is to remind everyone about the importance of taking things in context when it comes to investing. Never take things at face value. Because no matter how efficient and great index funds look on the surface, they don't meet everyone's needs, especially not the needs of the super rich. So, blindly comparing a handful of hedge funds with index funds in terms of net returns and concluding that index funds are better is not financially wise. Thanks for watching. If you've made it this far into the video, we'll see you all again in the next one.